Hello traders, welcome to the LFB and our global video charting review for January the 8th, 2011. We're going to look at the global commodity market, starting with the gold market. And please remember that there's a video disclaimer on the landing page that we would like you to read before accessing and reviewing in full the videos. Looking at the gold markets, we've got a signal trying to build around the 1345 area. Not sure at this point in time whether this is going to be a long or a short signal, but right now 1345 on gold does seem to be a swing point. And during the course of this week, we'll be watching this carefully for those of you looking to either add to existing positions one way or the other, or for those looking to build a new position. At this point in time, we've still got very bullish undertones on gold. We're very much aware of the fact that we do have resistance up at the 100-day simple moving average, just above the 1360 area. 3 sessions of heavy consolidation after the breakout move from the non-farm payroll report in anticipation of jobs being created or not. We've had that sideways crawl on the gold market, but we will advise via the newsletter and on the video if that signal follows through. Looking at silver, and we'd said over the course of the last couple of weeks that silver seemed to be the more bullish of the two hard commodities that we cover. Nothing coming in regard to a new signal on silver yet. The long signal from 28.40, which came on the 3rd of February, that hit its target. That was at 29.40. So the silver long target has been hit. We're now waiting to see what happens on this retest of 29 dollars on silver. So again, nothing to be done at this point in time because we're not sure whether this bullish undertone that we've got, which certainly favours buying the dips, buying the test of support rather than buying the breakout. We just need to monitor this and ensure that we've got this covered for those of you looking to add to existing long positions, or possibly for those of you looking for a contrarian play against the trend that maybe could just see silver dip down and test the 2750 area. We will update you on the video, but also on the daily newsletters as well. Looking at West Texas Intermediate. West Texas Intermediate is the most heavily oil contract traded. It's the most liquid globally. There are others, Brent crude, that you could use to analyze oil, but we like to keep an analysis of wherever the real momentum is, and you're going to get it a lot more in West Texas than most other oil contracts, that at a glance you get a fair reflection of all other oil markets. And looking at West Texas Intermediate, since we've had the civil unrest starting to quieten down just a little bit out of the Middle Eastern region, and the threat of the Suez Canal not now in play on a day-to-day basis, that there would be disruption to tanker flows going through the Suez Canal. We've had a little bit of profit taking coming out of West Texas Intermediate. We are trading at $86 a barrel. We do know 85 is an inflection point on crude oil, and at this point in time we're just looking, and the reason it's that 100-day simple moving average, we're just looking to see this test of that 100-day and see how that works through. The short signal was very, very mixed. It was a short signal from 90.30, but it came very, very quickly and also took into account the 50-day and the 20-day simple moving average, and it was against a very strong long trend, so it wasn't there to be taken advantage of. And now we're just going to wait patiently, see how this consolidates, and then make a move one way or the other, with either a move higher that fails and we'll issue a signal because a new short trend could be then forming in the midterm, or we'll be looking for a test of this 100-day moving average, break above that 50 and 20-day again, which is around the 89.90 area, and that would be a signal for us to go long on oil. There's been an awful lot of disruption in the soft commodity markets when we look at wheat, for example. Very, very volatile. We've had a gap on virtually every session. We've been limit up where the markets have had to stop. Circuit breakers have been hit and then move forward. Corn, exactly the same. And we are at yearly highs on all of these soft commodities. And really, this isn't just a demand where we've got global growth that is pushing demand for food. This is a lot to do with the food inflation, the raging inflation that's in commodity prices because of the Fed's quantitative easing program. Whether this is by design or by default, the US dollar is the denomination that global commodities are traded in, and the fact that the Fed is supporting the long side of equities, the short side of interest rate markets, by default the dollar will have downwards pressure on it. When you get downwards pressure on the US dollar, commodity prices are on the other side of that seesaw, priced in US dollars, downside pressure on the US dollar coming off equity and interest rate markets means that food inflation, this isn't actually necessarily people taking delivery, this is a traded object. Looking at sugar here, you would never see a sugar market in general that looks as volatile as that. These soft commodities historically have been fairly calm on a mid-term view. There's intraday volatility for sure. They go limit up, they go limit down, but you don't see these violent kind of swings that you're seeing in these soft commodities. You look at cotton um, and coffee. They're all the same. There's coffee up at 747. If you look at cotton, look at the movement. Look how violent these cotton markets have been. And again, that's a reflection of the volatility that's hit in the interest rate and risk markets. So at this point in time, not sure that oil or gold or silver or these soft commodities could be a precursor to something else you could trade in a different market that's normally highly correlated, because the new normal really is like being in a version of Alice in Wonderland where things get curiouser and curiouser.